Hello traders, welcome to a class on liquidity trading. So I'm sure by this point in your trading journey, you might have heard the concept liquidity thrown around once or twice, but it's very possible and maybe even likely that you don't have a solid understanding of what liquidity actually is, how it works, and how you can benefit from it. So that is what we're going to talk about today. So first of all, what is liquidity? Well, liquidity simply refers to orders or money in the market. So it's basically the availability of money for transactions in a market. Now, to break it down into simple terms, for a trade to be opened, there needs to be two willing participants ready to transact. So every time you buy, someone is selling to you. And every time you close a trade or enter a short position, a sell trade, someone is buying from you. It's basically a big auction and we are buying and selling to each other. Now, generally as retail traders, there is efficiency in the transactions that we take. There are trillions of dollars moving through the forex market every day, which means as a retail trader, like me and you'll pretty much have no issue transacting in and out of trades on demand, because your orders are never going to be that big that it stops you from actually selling everything you have or buying everything you have at one given level. With the amount of money available at any one time, unless you're trading multi-million dollar positions, you shouldn't really have too much of a problem getting in or out of your trades. However, there is some confusion that kicks into the market and some inefficiency that comes in due to the fact that we are not the only participants in the market. There are institutional traders like banks, funds, trading firms, investment funds, and these guys have a lot more money than us. And they are trading with significantly larger amounts of capital, which means they place significantly larger orders. Orders that are so big, in fact, that there's often not enough liquidity available at one level to get them into their full-size trade. And that can actually lead to bad pricing for these institutional participants when they enter a trade. So when we buy, we inject buy pressure into the market, which generally would push the market up if enough buying pressure came in. But as retail traders, our orders are by far not big enough to actually move the market. However, institutional orders can be big enough to move the market. If an institutional trader was just to execute a large buy here, they would actually push the market up. And then in order to actually get enough liquidity to enter their full positions, they'd have to be buying on the way up as traders from this area sold out to them. So they would end up with laddered orders, and that basically means they're not going to get one good buy price here. They're going to have staggered buys all the way throughout the large move, even leading to the top of the move. Now, obviously, this isn't ideal for institutional because that means they're going to get very bad positions and bad entries on their trades, which obviously limits the amount of money you can make significantly and could even turn a profitable move into a negative move, a losing move. So how does institutional avoid this? So here is a general example to break down what liquidity looks like in a market. So here we can see a market that has bounced from this invisible price area multiple times. Now, the majority of traders see this as a support floor, okay? So traders are going to be buying here in mass. Now, one thing I want to touch on, which I get asked a lot, isn't the concepts of supply and demand and liquidity and all of this the new retail? Because isn't everyone trading that nowadays? Well, I want to say you kind of do live in a bubble on social media, okay? There are hundreds and hundreds of thousands of traders around the world, maybe even millions, and actually a lot of them still use the very basic concepts of trend lines, chart patterns, and support and resistance. So no, the logic-based concepts do still stand true, and these support, resistance, etc., concepts are still being manipulated. Okay, so back to the topic then. In this example, there is a support floor. We know traders are buying in masses here, expecting the market to move up because it's failing to break through this invisible price level. So when we have buyers coming in at this level, the general retail education is to put stop losses beneath the low. So there will be a bunch of stop losses sitting just underneath that support floor where the traders are getting into their positions. Now I want you to think about this for what it is, going back to the auction concept. When we buy into a market, the only way to get out of that trade is to sell the position. So when we have a stop loss placed under our entry, when that stop loss gets hit, what we are doing is actually selling all of our contracts to the market, okay? So these stop losses will actually provide a lot of sell liquidity if they're hit, because all of the people buying there at support will be then selling back into the market if price goes down to that level. Now, what we will often see happen, and which you might have been caught in quite a few times, is what we would call a liquidity sweep. So this is a push down that trades into the stop loss area of all of those retail traders, because the retail traders don't have enough momentum to push the market away, and the market will naturally gradually sink down and trade into that area, which will actually provide massive amounts of that sell liquidity, and all of that selling provides the opportunity for institutional to enter into large buy positions. So the sell liquidity in the form of hundreds or thousands of stop losses will actually be absorbed into buy positions, and that is where the institutional traders will get in. And that is why you often see a move like this, where we have a support or resistance, we see the market go through it, because the amount of buying that's actually taken place at that level, now that the institutional has enough liquidity to get into true positions and big positions, that is where the big move will then begin, okay? So we understand the concept now, but how do we benefit from it? Well, there are two key ways that we can benefit from the concept of liquidity in our work. The first is we can actually avoid being caught up in the liquidity, because if we don't understand this concept and we're constantly buying from support and selling from resistance, we're actually just going to get caught up in this, okay? And that is obviously not ideal, because we'll just continually lose time and time again, which if you are a trader who uses these concepts, you probably just realize that this is happening to you. The second way we can benefit is to actually aim to enter where the institutional volume comes in. So rather than entering on the support here, we would actually look to enter down here on this liquidity sweep. That allows us to catch the major volume move with the big flow of the orders in the market. Now, how exactly would we know when to enter? Well, there are a few different ways, but I'm going to talk about the most simple way in this video because I don't really want to go too deep. It's going to turn into a very long video, but this will give you an actionable point to move forward with. And the most simple way to take advantage of this liquidity concept is to pair the concept with supply and demand. Now, if you don't know what supply and demand is essentially why the markets move. Supply and demand makes markets go up and down. If you have high demand, that is going to take up some of the supply. This pushes prices up. Think of it like diamonds, okay? They're rare, they're high demand, so the prices go up. People want them, there isn't enough. On the flip side, think of something with low demand, something that is easier to make or easier to access. A good example for this would be high street fashion versus luxury fashion. If you go to Gucci, there's not much of that, and you're gonna have to pay a premium to get it. If you go to a high street shop, you can spend a very small amount. There's not massive demand for those clothes, and there's a huge supply, so the prices are cheap. But that is exactly the same thing that happens in the market. If we have high demand for a currency or asset, the prices will go up as people buy up. If we have low demand, prices will decrease because people will be selling out of those positions and the demand for that asset will simply go down. Now, this can actually be visualized on the charts. We see supply and demand as zones. And these zones are basically visualized as consolidation areas before big up or down moves. Now, consolidation is basically a phase where the market goes sideways before we get a big push up or down. So here's an example. On the left, we have a supply zone. Basically, we see here, we have this consolidation before this big down move. When the market pulls back to it, we sell off again. That is the supply zone. Demand zone, we have a demand here, the market pushes up. When we pull back to that demand, we hit it and the market pushes up again. So that is where the demand is entering the market and that is where the supply is entering the market. All right, so here we're looking at GBP USD. This is a 30-minute time frame. And what we can see is the market is making a range. Now at the bottom of this range, we have this support area. We have the 1, 2, 3 taps into this invisible area. We know there are going to be people buying at this level, okay? Because that is general retail education. Buy support, stop loss under the low. So we have buys and then we have a lot of stop losses under the level. And what do these stop losses indicate? Sells, because to get out of your buy, you need to sell. So if the market goes to here, there will be hundreds or thousands or tens of thousands or hundreds of thousands of sell orders available at this level. So what we could generally expect to see is the markets to sweep into this and then make its big move, because that is the institutional orders opening up the sell liquidity to actually get on full size positions, okay? So obviously trading this alone is a little bit difficult, but if we compare this concept with something that gives us clear entry points and clear places to buy or sell from, it becomes a lot more simple. And that is what we're going to do with the supply and demand. So if we look over here to the left, what can we see? We can see this consolidation area before the big up move in the market. So what I would look to do is actually grab the demand area at the bottom of this move. Now, I personally indicate demand as the last candle before the impulse. You can see here we had consolidation, we had this final candle, and then we had the push away. So this would be my demand. You could obviously stretch it over higher if you wanted to, but that would be the area that I personally focus on as a demand zone. So my idea now would be, basically this is going to be the area of liquidity. And what we would look to do is see the market trade through this area. And once it trades into demand, that would be at buy point. And this is the most simple way to take advantage of liquidity in the markets. If you identify those equal lows or those equal highs, all you then need to do is identify a supply or demand zone in the direction of the larger trend and place your orders around there. So for this specific trade, if we're expecting the market to sweep out the low, the safest possible place for us to get in would be to buy at this level. We would then put our stop losses under the area, because if it does break, we were wrong about the trade. And then we would look to push it towards wherever our targets would be. For this example, let's just target this previous high. So now all we do is wait, and if the market does liquidate, we can hopefully get in right at the peak of that push down. Now, why does the market return to these demand areas when it's sweeping liquidity? Because as well as us knowing there is a lot of selling going on here, we know there's a lot of buying waiting at this level. So we can collect even more buying pressure down at this point, leading into a larger move. And you'll see this pattern repeat many times. Obviously, it's not going to look identical to this, but it will be a very similar concept of demand into an area of liquidity, then a pullback through, liquidate that, trade into demand, and push away. Okay, that's what we're seeing here. Demand, push away, pullback, liquidity. Now we're looking for a sweep of liquidity, trade into demand, then that's when we get a real move. So guys, let's play this out and watch how this goes down. So there you can see the market traded down into that demand zone, tapped the demand, collected that final bit of buying pressure, and then pushed away. And as you can see, it allows us to get a precise entry. And if we consider that to the traders who are buying support, they would have been buying at this level with stops below. So anyone who bought at this level with stops in this area, this key area, they would be taken out. Whereas we are looking to actually join where the institutional volume is kicking into the market. And by pairing the liquidity concepts with supply and demand, that is the easiest way to do just that. So what I want you to do now is go over to your chart, use the replay tool and backtest this concept. Have a look through and kind of try and build an eye for this in the markets. One thing that's cool about this concept, it is a fractal concept, which means you could trade this on the 1 minute, the 30 minute, the hourly, the daily, the weekly. It does not matter. It is going to formulate across every single time frame. Being a logic-based concept, basically following the flow of the market, it's going to be visible anywhere you look. So take some time to test it out and then give it a go in the live markets when you are ready to do so and you've got some data behind you suggesting that you understand the concept properly and you won't lose money doing it. If you want to learn more about logic-based concepts, head to the link in the description. There's a free training. It's an hour long. It's going to talk all through the different logic-based concepts that I use in my trading system and also set you up to get you on the path to your first $10,000 month and then beyond. I hope you've enjoyed the video, guys. Thank you for watching and I'll see you in the next one.